All right. So finishing the thought pattern from the previous video, now we're taking that data and that base that base case for real GDP and putting it into what effect that's going to likely have on the Fed rate hiking cycle going forward. And so a lot of this has to the way that I look at this is that the Federal Reserve in 2019 is probably only going to hike one time, and that's sort of my base case for 2019, which kind of aligns myself with. It doesn't align me fully with the market because the market thinks zero, but it aligns me with what the Fed really wants to do. So the Fed ultimately really wanted to hike three times in 2019. That doesn't seem like it's very likely. So they're not going to be tightening at that pace anymore, and they're going to be more accommodative. But I think they'll probably still get in one hike. And so what I'm forecasting is that the most likely hike is probably going to take place in. I think it's probably most likely going to take place in May. May seems like the most likely point at which the Federal Reserve is going to hike rates, and so that pushes the final rate hike to about 2.75%. And I think ultimately the Fed's going to be in a position where it's going to have to lower or subtract and reduce the federal funds rate in the first quarter January of 2020 by 25 basis points. So I think the Fed for the first half of 2020 is going to be at about the federal funds rate is going to be at 250 basis points to start January. So I think that and like I said, I think the recession, given the way that I forecasted it out, it's going to be a very V-shaped recession because of the U.S. Position in terms of the competitive advantage that the U.S. has in terms of the export sector and the ability, and what's ultimately going to also change in the global current account deficit countries versus the global current account surplus countries. So countries that were originally surplus countries may move into deficit countries, China being one of those, and countries that were countries that were surplus countries may move into deficit large countries, China being one, and then countries that were deficit countries actually may start to close that deficit and ultimately move into surplus later in the 2020s, and that would be the U.S. And so ultimately, I think that V-shaped recovery hinges on the fact that the U.S. economy will be able to readjust and rebalance toward the export sector, where the U.S. has a strategically advantageous position in terms of exporting petroleum products and crude oil to major growth regions in the world like India and China and other parts of the Asia Pacific. So I think that actually will, and the weakness in the U.S. dollar that will take place from Q3 2019 through Q4 2019 and into Q1 2019 and Q2 will ultimately allow that to take place and allow that to happen. Now the other issue, obviously, it goes back into the twin deficit and what sort of effect that will have. And I'm just not buying the argument that yields are going to be rising substantially and that the market's not going to be able to absorb the issuance from the Treasury as well as the reduction in the balance sheet and runoff of mortgage-backed securities and U.S. Treasuries. Obviously, volatility is going to increase over the course of that period in time. But those are some of the factors. So ultimately, my base case forecast for 2019 is to see that the Fed remains fairly accommodative and that they're only going to do one hike, and that ultimately they're going to be in a position where they actually have to lower rates in 2020, in January of 2020. Now there is a worst case scenario, right? So if you listen to my worst case scenario for GDP, which was 1.34% for 2019 and then 0.1% for 2020, then that puts the Fed in a completely different position. So I still think the Fed basically goes all the way through 2019, but I changed my rate hike in May to a rate cut in September. So instead of being at 275 basis points for 2019 on my base case scenario, my worst case scenario assumes that 2019 basically ends the year out at a rate cut at 2.25, and the federal funds rate is at 2.25, and that rate cut happens in September. And then if it gets really bad and if the data really deteriorates, I ultimately see that there could be a 50 basis point rate cut in January of 2020. And that would again be the worst case scenario. And then that 50 basis point rate cut is followed by another 25 basis point rate cut in May of 2020. But that again assumes a worst case scenario that I don't think is likely to play out. That would be, again, if growth were to fall below trend and the Federal Reserve was stepping in there to provide more of an easy policy. So, and they could do that through a number of ways. So the runoff with treasuries and mortgage-backed securities, they could slow that process, and which doesn't seem likely, obviously, as they indicated that that's not going to be a likely scenario. But there's a number of things that could take place and ultimately happen. So having said that, that's sort of kind of where I see the Fed right now. And again, like I said, the market's leaning toward the 0 hike for this year. I'm leaning toward 1 hike in May, and then a rate cut in January. So where I agree with the market is that there's going to be a rate cut in January. Where I don't agree with the market is that I still see that the Federal Reserve is probably likely to hike. And why I think they're going to be able to hike has to do with the fact that I think the second quarter, once we get past the slowdown, historically slow first quarter, we'll likely get a nice bounce now that the government will get its act together and fund itself at the start of the end of the first quarter and the start of the second quarter. So you get a nice bounce. And that 2.8% should be pretty good, and the market actually probably will respond pretty well to that. And then also it coincides with some of the trade negotiations that could possibly happen that really aren't material things, technically speaking, because of the way that China actually really operates. They're fundamental things that the market actually may respond positively to. China, when I say it's not material things in the way that China operates, China's on a 5-year plan, and they're not going to deviate from the 13th 5-year plan because of the current administration's tariffs or anything like that. What they may do, though, is that they're coming up and they're starting to renegotiate what they're going to do in their 14th 5-year plan from the start of 2020 to 2025. So that may have an influence on what they decide to do with that plan. Either way, like I said, it positions the U.S. in 2020 after the recession to shift the economy over to the export sector, where the U.S. has a substantial competitive advantage in terms of getting U.S. exports of energy and agriculture and services like financial services and other things out into the market, because also that coincides with the 2020 opening of the financial account in China and Chinese account liberalization, which will again allow capital to come out of China, most likely into the U.S., but it also allows capital from the U.S. to go into China and those sorts of things. So that's sort of kind of where I see Fed policy. In the next video, I'm going to talk about where I see the U.S. equity market and sort of kind of how I got to those numbers. So if you like it, continue listening.